For more on the impact on the markets, let's bring in Savita Subramanian, the U.S. head of equity and quantitative strategy at Bank of America. Savita, great to speak with you, especially as we do have this breaking news. Could this be sort of the black cloud over the market?
Yeah, no, I think that, I guess I would agree with Guy. This isn't particularly surprising. It's really more of what we've seen in terms of just a shift from global economies to more localized economies. And I think that this is, the timing is we're heading into into campaign season. I think that this is just another driver for companies, multinational companies, shifting supply chain risk, diversifying supply chain risk, or bringing it back to the U.S. I actually think this could be shorter-term positive for the U.S. economy, because if you think about it, just bringing manufacturing capabilities back to the U.S., kind of shifting to more of a local economy could actually be good for U.S. economic growth. It could be good for smaller companies. We could see sort of a little bit of a pickup in manufacturing in the U.S., which has been a sore spot throughout this bull market, the 10-year bull market that we had. So I think some of this could actually benefit the U.S. economy, but I think it's kind of more of what we saw even pre-COVID, and it's basically been hastened by the pandemic, which is the idea that U.S. companies are being incented to essentially onshore and then think more locally rather than globally. But it is an interesting development, and certainly one that merits further exploration.
We've been teasing you, Savita, in terms of what your headline could be in this segment, and we've been saying that you have one sector that's an all-time buy, and it does seem to play into sort of this idea that we are going to have a recovery. So what is that sector? And do you see a sharp recovery in the U.S. economy from the pandemic?
So the sector, the punchline is banks. And as you know, I've come on this show and talked about banks in the past. I think what's really interesting about financials right now is if you look at China. So China has, come back online. We've seen activity start to normalize in China. They're maybe a month or two ahead of us in terms of the outbreaks and the quelling of the outbreaks. And what's interesting is that in China, the sectors that have come back to full capacity of what they were running at in April of last year are financial companies, banks. We're seeing this with other manufacturing segments. Where we're not seeing it, and this is what you were talking to before the breaking news, where you're not seeing that immediate recovery is in the consumer-oriented areas of the economy. So when I look at financials, I think, okay, great, this is a sector that's probably going to recover faster than others in an upturn. It's also priced relatively conservatively. It still looks relatively cheap versus other areas of the market. And then when you think about quality, it's got income potential. And then the kicker, and the reason I'm bringing it up on fast money from a trading perspective, is that it is deeply underweight by investors. So it's right now carrying about a 10% underweight in the average mutual fund. Then you compare this to, bank stocks, which are carrying almost a two times overweight. So I think there's a lot of opportunity here to pick up cheap financial companies that could benefit the most from a recovery, or benefit the earliest at the very least.
All right, Savita, always great to speak with you. Thanks for your time. Savita Subramanian of Bank of America. Tim, what'd you make of Savita's thoughts?
Always interesting thoughts from Savita. And it's funny because when Dan mentioned that the airlines in the last block are kind of representative of maybe really either where the market is or they're doing a nice job of kind of bringing in temperance, I would argue also that the banks have done that. And maybe the banks have been the most mispriced relative to the S&P. And this is what I hear Savita saying. Think about the drivers also for banks. Not only do you have these banks trading at 30% price to tangible book discounts to where they were, but you have these earnings reserves that have been put aside. These loan provisions that have been put aside, and you have, I think, a major tailwind. We've seen that in the past. Now, I don't presume that there won't be significant loan and credit issues, but for the most part, these banks have already been extremely conservative in how they have assessed that. And so I do think that the banks are going to be the most cyclically exposed, and they're the ones that at this point in the market with the S&P, 2850 to 2900, this is a case where the banks have not kept pace with this rally.
Karen, just quickly, in terms of the banks, your top pick right now?
Well, I have the most money in J.P. Morgan,
Okay.
and second, Bank of America.